How does adding investors change your startup's exit? Before you decide to raise money from angels or a venture capital fund, you need to make sure you understand how this will affect your startup's exit. Then you can decide whether it makes sense to take funding from an angel or a VC, or whether you should continue bootstrapping your startup. In today's video, I'm going to explain: should you take VC or angel funding? How investors view an acceptable exit? What happens to your exit if you raise funding? And what happens to your exit if you don't raise money? I hope you like it. Hi, I'm Brett. On my channel, I help early stage startup CEOs like you raise money and grow your startup. So if this sounds like you, then hit the subscribe button and the bell so you get notified every time I release a new video. Let's get started. Should you take VC or angel funding? One of the first questions you're likely to ask yourself as you consider whether to bootstrap or take VC or angel funding is whether you'll make more money taking external funding. I think this is the wrong question to ask. Instead, I think the right question to ask is whether or not taking VC funding or angel funding will increase your chances of success. If the answer is no, then obviously you shouldn't take external funding. If the answer is yes, then this leads to another set of questions that you need to ask. Do you and your investors agree on the long-term vision of the company? Do you and your investors agree on how much money your venture is going to need? Do you and your investors agree on the key milestones your venture needs to achieve and when you need to achieve them? Then finally, and most importantly, do you and your investors agree on what an acceptable outcome for your venture will be? This leads to our next question. How do investors view an acceptable exit? I'm only going to focus on early stage VCs and angel investors in this video. It's important for you to understand what investors expect. Here's why. If you think that if you get an offer to sell the company for $60 million and that you believe is okay, and your investors are looking for a sale in the $600 million range, then you've got a problem. Worse yet, your investors will likely block the sale of your company. Now, I hope you get an idea of how important this is. Let's walk through a simple example so you can see how this works. Your company raises an angel round of $1 million. Your new investors now own 10% of the company after the investment. This is what's called a post-money valuation. Your company is now valued at $10 million. Let's say in the simplistic example, you don't raise any more funding. Now, what does an acceptable exit look like? Early stage angels and VCs are looking for returns of 10x to 30x on their money. So an acceptable exit would be a sale of your company in the range of $100 million to $300 million, netting the investors $10 million to $30 million. Now, unless you believe your company can realistically be worth at least $100 million, then it's going to be difficult to raise external funding because angels and VCs are likely to realize the same thing, and they're not going to get the return that they want. What happens to your exit if you raise funding? The second you take external funding, you have lost control of your company. Now, this doesn't mean that your investors are going to tell you what to do and micromanage you. It does mean that your investors are going to have expectations that you're likely going to have to be aware of. And as I already pointed out, they obviously care about the exit. Taking money from angels and VCs affects a potential exit in a couple of different ways. The first is investors will try and block you from selling the company for a small return on their money. Let's use the $1 million investment as an example. You get an offer to sell the company for $20 million 1 year after the investment closes. The founders and the employees own 90% of the company in this example. Then you and the founders and the employees would get $18 million, and the investors would get $2 million. The investors, unless they think your company is a disaster, will not be happy with that return because it's just not enough. And they will block you from selling the company. The second way a potential exit changes is in a forced sale. For example, let's say that instead of raising $1 million, you've raised $20 million over a few rounds of funding, and you, your co-founders and employees own 60% of the company. Let's say that you sell the company for that same $20 million. Now the liquidation preferences come into play. Liquidation preferences determine who gets paid first in a sale of the company. Typical liquidation preferences are 1x or 2x of the investment. Let's say it was 1x. This means the investors will get their $20 million back before you get to participate. So in this scenario, you get nothing unless the investors decide to give you a small amount out of generosity. And that does happen, by the way, from time to time. Now, if this content is resonating with you, then please hit the like button right now. What happens to your exit if you don't raise money? The good news is you and your team get 100% of the proceeds if you don't have investors. That's the good news. And if you think your company is going to be sold for a smaller amount, like in the $20 million example, or if you're thinking you want to sell quickly, then you're much better off not raising money from angels or VCs. Now here's a summary of what we've learned today. Number one, the right question to ask is whether taking angel or VC funding will give you a better chance of success. Number two, you need to understand whether you and your potential investors view a successful exit similarly. Number three, taking angel funding or VC funding will significantly reduce your return on a smaller sale. In fact, you could make nothing. Now, what did you learn from today's video? Put your answer in the comments column below today's video. And if you have any questions, put them in the comments column too, and I'll be happy to answer them for you. Now, I have one more thing for you today. It's my free startup pitch deck template. It has all the slides you need to develop an awesome pitch deck. Click the link below today's video, and it's yours for free. And for more great content, click on the video at the end of today's video. And if you haven't already, then click the subscribe button to get notified every time I release a new video. Now, I'm Brett at brettjfox.com. Thanks for watching today. Take care. Bye.